This video will only take up a tiny fraction of your day, but it will absolutely have a very positive effect on the rest of your investing life. What I'm about to share will help you avoid the most costly mistakes investors make and set you up for long-term financial success. And make sure you stick around for the end because I am saving the biggest mistake for last. It's one that even seasoned pros are still making to this day. So stick around for that and let's get started. When it comes to your portfolio, it is crucial to understand the risks that you are taking on. It's easy to focus on the potential gains and overlook the fact that markets have, can, and will again go down. If your portfolio isn't aligned with your risk tolerance, or if you're not properly diversified, you could be taking on a lot more risk than you're prepared to handle. A well-diversified portfolio can reduce your exposure to market downturns. If your portfolio is too heavily concentrated in one asset class, like stocks or individual sectors, you're exposing yourself to higher volatility. Even globally diversified portfolios aren't immune to market downturns like we saw during the COVID-19 pandemic or before that, the 2008 financial crisis. So say you had a globally diversified portfolio with about 1/3 Canadian, 1/3 US, and 1/3 international stocks. So an all equity portfolio. And they are all total stock market index ETFs. So you are about as diversified as you could possibly be within the equity space. During the COVID-19 crash, your portfolio still would have seen a 35% decrease in just over a month. The 2008 financial crisis was even more severe as your portfolio would have dropped by 50%. So even though your portfolio was really well diversified, it was still an all equity portfolio. So you still would have experienced a lot of risk and a lot of drawdown. It's one thing to say you are comfortable with risk, but how much can you truly handle? If you haven't actually lived through those market downturns, if you haven't seen your portfolio drop by 35 or 50%, it's impossible to know how you are actually going to react if that situation happens again. It's happened many times in the past, and something like that is bound to happen again. So it's essential to build a portfolio that aligns with individuals' personal risk tolerance. Many investors go beyond broad market diversification and they pick individual stocks or focus on specific sectors. Now this just increases risk that much more. I talked about 35% or 50% drawdowns in a portfolio. When you invest in individual stocks or sectors like that, you could see your portfolio drop by way more than that. Imagine you had a $100,000 portfolio and then it dropped to $20,000 within 6 months. How would you feel about that? So narrow sector bets can turn very risky very quickly, and investors need to be very careful. Start by assessing your true risk tolerance. If the thought of your portfolio dropping by 35 or 50% keeps you up at night or makes you very nervous, then you should definitely look at safer assets like bonds and fixed income. There are many great resources online, like questionnaires, that can help you better quantitatively assess your risk tolerance so that you can come to a proper asset allocation, so the appropriate mix of stocks and bonds for you. Financial planners can also do this. They don't help with individual investments typically, but they can help you better understand and define your risk tolerance. Ultimately, as you've probably heard and or read before, investors need to do their own due diligence before making investment decisions to ensure that their portfolio aligns with their financial objectives and their personal risk tolerance. Okay, so managing your portfolio's risk is one key step on the way to financial success, but even with the right portfolio, there is still one mistake that can undermine everything, and it has nothing to do with asset allocation or risk tolerance. So stick around because we're building up to that, the biggest mistake that can derail your financial future. Another major mistake investors make is focusing too much on short-term results and not looking at the big picture. It's easy to get caught up in the short-term gains that can be made or the short-term market drawdowns, but focusing too much on this can really distract you from your long-term financial goals. When you're always looking for the next hot stock or sector, it's easy to lose focus on your overall strategy. Investors often chase hot-performing stocks or sectors after they've already had their run, hoping they can still ride the wave. But by the time they jump in, they are often too late and they expose themselves to the risk that I talked about earlier. Any investment advisor worth their salt will tell you individual investors cannot time the market and they can't reliably beat the market over the long term. So they can't reliably perform better than your standard broad market index funds. Okay, so for instance, during the COVID-19 market rebound, many individuals got into tech stocks because they were hot. But soon after, many of those stocks became the exact opposite of hot, and we are going to look at a specific example. So let's focus on the NASDAQ 100 Technology Sector Index. This one specifically tracks just technology stocks within the broader NASDAQ 100. So we can clearly see when COVID happened, here is the peak and then the drop during COVID, and then this is the market rebound. This index got all the way up to a height of 9,846 and change on November 19, 2021, and then dropped all the way down to 5,350.93 less than a year later. This was a drop of more than 45% at its peak. So let's compare this to the behavior of a globally diversified all-equity portfolio. iShares Core Equity ETF XEQT will provide a good example for this. At its peak, it had a value of $28.15. Now, this is a lot less than the point system NASDAQ uses, but let's not let that confuse us. We want to see the difference. So this ETF began at $28.15 and dropped down to $22.54. Now let's look at a comparison between the different investments. A Canadian would have lost just under 20% had they had a globally diversified all-equity portfolio represented by the ETF XEQT. Had they invested in the NASDAQ 100 Technology Index, they would have lost about 46%. If they had purchased individual tech stocks, which is almost certainly more likely, they could have fared much worse. One more example, a more balanced portfolio. Let's look at XBAL from iShares. It contains a similar mix of equities to XEQT, but it also contains over 39% in a very diversified set of bonds. An investor holding that ETF would have seen a drawdown of only about 17.5%. Typically, a balanced portfolio would have fared a little bit better than that, but if you recall at the time, inflation really started to kick in, and so bonds really took a hit. Now, these numbers were based on a Canadian dollar portfolio, not including Forex changes, which didn't amount to much over that period. Also didn't account for dividends, but the two example ETFs actually paid out about twice as much as the tech index. So what does this mean? Chasing performance often leads to selling low and buying high, which is the exact opposite of what we want to do. That practice is obviously very detrimental to our portfolios. So when you focus on the short term, you can easily lose sight of your long-term goals, like buying a house or retiring. Investing is a marathon, not a sprint, and short-term results can be very deceiving and distracting. Your portfolio should be designed to help you achieve your long-term goals without chasing short-term gains. Here's a tip. Build your portfolio around your long-term financial goals rather than short-term market trends. Stick to a strategy that is designed to grow your wealth steadily over time. By keeping your eyes on the prize, the long-term picture, you can avoid the distractions of the short-term market noise and focus on what truly matters, your personal financial milestones. So it's crucial to stay focused on your long-term goals and not get distracted by short-term market trends. But there is one mistake that seasoned pros are making. I mentioned it before. We're going to talk about it at the end. It has nothing to do with stock picking, nothing to do with market timing. That's coming up. But next, mistake number 3, which is a huge one. If I could just take one moment to shamelessly request that you subscribe to my channel, I would really appreciate it. Okay, now here's a mistake that can completely derail your investment plan. And it's pretty simple, spending too much money. This one might seem really obvious, but in today's consumer-driven world, it's really easy to spend a lot of money, but think that we're normal. Normal people spend too much money, so we can't be normal if we want to retire at a normal age and have a normal quality of life in retirement. Shout out to Andrew Hallam, Millionaire Teacher. Great book. Check it out. As your income grows, there's a tendency to spend more rather than save more. It's called lifestyle inflation, and it's really easy to have it sneak up on us. While rewarding yourself isn't inherently bad, it can easily become a habit and limit your ability to build wealth. Every dollar you save today is a dollar that can work for you and your future through compound interest. But if you're constantly spending, then you're missing out on the exponential growth that comes with saving and investing consistently. And I'm not saying it's all about cutting back. I'm saying it's about prioritizing your future investment goals rather than just short-term rewards. Let's say you get a $5,000 raise, but instead of upgrading your car or going on a vacation, you save that money in a registered account. So if we invest that $5,000 at an average annual return of 7%, in just over 10 years, that money would double to $10,000. Now, if you're able to contribute that $5,000 every year for the next 20 years, your total contributions of $100,000 would grow to over $219,000, more than double your initial investment. That is the magic of compounding interest at work. Okay, so here's a hot tip to help avoid this mistake. Automate your saving. Automate your contribution to a registered account. If money is coming off of every paycheck and automatically going into your registered account, you don't even have to think about saving it, and you don't have the option of spending it. This is an easy way to ensure that you are saving consistently and not spending on things that don't really have an impact now or on your future self. Now we've come to the biggest mistake that can truly derail your entire financial future. This one is closely tied with some of the others that I mentioned earlier in this video, but it deserves to be the main event and stand alone because it alone can truly derail everything that you have worked for. In my opinion, it's the worst mistake investors can make, so that's why I have saved it for the main event. And like I said, it's a mistake that even trips up the most seasoned investors. It happens when people let emotions like fear and greed drive their investment decisions. We know the classic advice, buy low and sell high. Well, in practice, many investors do the exact opposite. As I touched on earlier, markets can be incredibly volatile, so this is when emotions really come into play. When markets drop sharply, fear can easily take over. If investors make mistake number one, where they're not understanding the risk of their portfolio, or mistake number two, where they are too focused on the short term, they are more likely to panic when markets are declining. This leads to investors selling off their holdings at one of the worst possible times, locking in their losses. On the flip side, when markets are soaring, a lot of people buy into stocks or individual sectors when they are near their peak. Buying high and selling low. We've seen this happen over and over again. Talked about the COVID crash, talked about the 2008 financial crisis, the dot-com bubble before that, and there have been many smaller dips in between those events. Investors who panic and sell during these downturns, they never buy at the bottom, right? They buy once the market has recovered, once they can see that it's been going up for a while. So they locked in their losses and they didn't experience the benefit of the market recovering. This behavior is exactly the opposite of what successful investing requires. Let's look at a specific example around the 2008 financial crisis. From October 2007 to March 2009, the S&P 500 dropped by 57%. Many investors panicked and sold off a lot of their portfolio at rock bottom prices, thus locking in significant losses. And many of those who sold during the downturn were often scared to get back in, so they missed out on a lot of the recovery thereafter. So by 2013, the S&P 500 had fully recovered, so many investors missed out on that recovery because they were too scared to buy back in. So they missed out on the recovery, the rebound, thus all of those gains. By 2019, the S&P 500 had nearly doubled from where it was at 2013. So you can really understand how a lot of investors really missed out on not being in the stock market at that time. Those who stayed invested and weathered the storm really benefited from the recovery, while those who sold off really negatively impacted their financial futures. Here's the hot tip for this one. One of the best ways to avoid emotional decision making when it comes to investing is to have a solid long-term plan and to stick to it. By building a diversified portfolio that matches your risk tolerance, you're much more well equipped to be able to handle turbulent market conditions and avoid the knee-jerk reactions. If you've done your research and you know that your portfolio is built to withstand these market downturns, it's much easier to stay the course during difficult times. So by understanding your risk and focusing on your long-term goals, you're much better equipped to be able to avoid the pitfalls of emotional decision-making when it comes to investing. Before you do anything else, please subscribe and ring the bell wherever it is to make sure that you don't miss out on our next video. So if you have experienced any of those market crashes I talked about, please leave a comment. Let me know how you felt at that time. Maybe how you reacted, if you don't mind sharing, if it was negative or if it was positive. Hey, share it. Let me know. That would be great. I'd love to hear from you. A thumbs up would help a lot too if you liked the video. And remember, the key to financial success isn't just picking the right investments. It's also about avoiding the major pitfalls along the way. So stay the course. Thanks for watching. We'll see you again soon.